Joining me now with more is Larry Werther. He's the chief U.S. economist at Daiwa Capital Markets. Larry, it's good to have you on the show today, joining, of course, here from the New York Stock Exchange. And for viewers watching, wondering what to think of all this, what would you tell them?
I would tell them that caution is the rule of the day right now. Recession is still not my baseline, but I think the odds have risen. So for the investor community, proceed cautiously in your respective product. And for the population, wait and see. Don't make any rash decisions. Maybe postpone some purchases, but it's a lot of unknown unknowns right now.
Okay, postpone some purchases. What about for anyone looking at their portfolio? What are you recommending to clients?
Absolutely. You know, I think it is a wait and see period right now. Certainly you don't want to be selling into the decline that we've seen, but I don't know yet if it's time to put money back to work. President Trump seems pretty adamant in staying the course, and that certainly, if nothing else, means continued volatility.
So we saw a very dramatic pullback, certainly the final 2 days of last week in markets, setting up for a 2% plus drop at the open for the S&P 500. Stocks will open in just about 15 minutes time here. That means the S&P is looking at a bear market, which would be a 20% drop from a recent high. Selling that escalated very quickly. What are the potential concerns here, especially when it comes to financing?
Okay, so yes, certainly. I think there is, at least with respect to financing, credit markets have tightened. We've seen spreads blow out a little bit. Interest rates, on at least on prevailing level basis, have come down, but I think you will see a continued pullback in the willingness to extend credit, in this environment, whether it's on a short-term basis, whether or not, it's on a longer-term basis if you look at consumers. So I think caution prevails in those markets as well.
Does that mean lower interest rates?
Could be, and when. I think Chair Powell was adamant on Friday that he is exercising patience right now. Markets are pricing a coin flip with respect to the May FOMC meeting, but I think Treasury markets are pricing lower, but with respect to the Fed, I'd still be thinking June the earliest.
June at the earliest. You're right. The Fed chair did note with these tariffs, he anticipates higher inflation, aggregated inflation, I think was his particular word there, and potentially slower growth. The jobs report on Friday was quite strong, 228,000 jobs added in March. We've seen what's been dubbed the soft data, sentiment weakening for months now, but the hard data hasn't necessarily aligned with that. What does that tell you about the state of the economy now?
It's hard to make any broad prognostications going forward, but at least as of March, the economy was good. The unemployment rate was up fractionally, and that led to, rounding up to 4.2%. So hiring was pretty good. The household balance sheet was strong. I think companies were willing to invest, but sentiment, I think, has shifted, but we're not going to really see that show up in the hard data for at least another 2 to 3 months. So it's I think a challenge as a forecaster what you would assign more weight to right now.
So let's ask what we know now about tariffs, right? Which, of course, includes the president's announcement last week. Every indication that we've heard from the president and members of his cabinet that he is not backing down. These tariffs are sticking around, and he is going to play tough when it comes to any sort of potential negotiation. What does that mean for the economy?
Sure. I think it means that growth risks are more substantially tilted to the downside. They were already. As I think about growth for the year, I'd be thinking about economic output on a Q4 to Q4 basis, maybe in the vicinity of 0.5 percentage point. Look, President Trump wants to do one of two things here. He wants to either re-engineer the global trading order, or he wants to extract concessions from trading partners, and it's tough to discern out what that means or which direction he'll tilt in, but net it means a slowdown in the U.S. economy, increased recession risks here and certainly abroad as well for the global economy. What
would be the impact on inflation? Because if consumers are nervous and they start spending less, could that bring down and maybe offset some of the inflation hikes that would be in effect because of tariffs?
So Kristen, you raise a good point. And my thought would be, all else equal, assuming some tariff effect, some slowing in demand, I'd still put a 3 handle on core PC inflation this year. There's almost certainly going to be some pass-through because of higher costs borne by importers and sellers. But if you get demand destruction as well, it could put a cap on that. I'm probably a bit below consensus. I've heard people talking mid to upper 3s for core inflation. I'd probably be in the low 3s right now, at least on account of the demand destruction component.
All right, Larry Werther, he's a chief U.S. economist at Daiwa Capital Markets. Great to hear his economic take. Larry, thank you.
Thanks for having me, Kristen. It was a pleasure.
Great to have you.